What is going on, everybody? Welcome back to Have More Than Money. In today's video, we are going to be discussing our number one favorite book to get started on learning how to build wealth and creating wealth for yourself. I'm sorry, I said our favorite book, our second favorite book behind Jared's ebook, Have More Than Money. You can get that at havemorethanmoney.com. But yes, our second favorite book about building wealth, and that is Rich Dad, Poor Dad by Robert Kiyosaki. It's just an amazingly written book. Like I said, just teaching you how rich people do it. Jared, if you want to just kind of give a quick summary of what it's about.
Yeah, I mean, the whole video is going to be us summarizing the book, but a quick summary of the summary is, I mean, it really is just about the best book, I would say, for anyone that has no financial intelligence. It really does give you a foundation. Now, the book doesn't necessarily give you any actionable advice, and hopefully this video will give you some actionable advice, but it really does give you a great foundation for financial intelligence. For anyone that is, just starting to make money or has a job coming soon, or even if you've been working at a job for 15, 20 years, the knowledge given in that book can ultimately make you very wealthy.
Yeah, exactly. And so pretty much how the book is written is, as the title of the book is Rich Dad, Poor Dad. And so Robert Kiyosaki, pretty much when he talks about his two dads, his poor dad being his actual, blood father, who is pretty much your typical middle-class American, works a job, believes in hard work, believes in that secure job. And then his rich dad, who is actually the father of one of his best friends. And his rich dad, which he refers to throughout the book, pretty much takes him and his friend under his wing and teaches him everything that there is to know about, like I said, creating wealth. His rich dad's a business owner. He invests in assets, but we'll get into all of that in the video.
Yeah, one thing just to acknowledge about, the rich dad and poor dad relationship is that, and this is very common. So, if you're watching this and you're going through this, understand that you're not alone, is that he was fighting with the poor dad quite often because he realized that what the rich dad was saying was right and what his actual dad was saying was wrong. And I know a lot of kids watching this that are thinking about becoming entrepreneurs are probably getting swayed to not become entrepreneurs by their parents. But it's very important that if your parents are not wealthy, then you do not take their advice with finances, because if they knew what's right, then they would have the results themselves. And I'm not saying that this is to bash your parents. I'm sure they're great people, but the fact of the matter is that if they aren't rich, then they can't help you in finance. They can guide you every other aspect of life, but tell your parents, mom, dad, I'm going to learn how to make money my own way.
Yeah. And I'm really glad you brought that up, because that's something that Jared and I, we both dealt with personally with our parents. Is, it's not that they're trying to, ruin your life. It's not like they want bad for you. They're looking out, and they're telling you what they think is your best interest, but they don't know what's in your best interest.
Perfectly said.
Yeah, and so like I said, it's not like they're trying to spoil you and like ruin your future. No, it's not what we're saying. Like I said, and as Rich Dad Poor Dad talks about, is there's two ways to do things, and like I said, we'll dive into two different ways right now. Like I said, the first thing that we want to talk about and that Robert talks about in the book is how you can't work for your money. You need your money to work for you. And Jared, if you want to kind of just explain the quote and give some examples.
And before I even explain that quote, I don't know if anyone here has watched The Social Network, but just a quick little funny thing was one of the guys, Eduardo Saverin, listened to his dad and got an internship to make his father happy. And over that 3-month internship, Mark Zuckerberg took Facebook from the small company to pretty much huge company. And Eduardo Saverin, since he decided the internship, instead of helping Mark, he ended up going from 30% owner to 0.00003% owner, and got screwed out of, obviously, as we know, Facebook is worth $80 billion today. So, just again, the biggest company in the world, this guy owned 30%, but since he listened to his parent, who thought he knew it was best, it was a summer going into his senior year of college, I believe, and instead of flying to California with Mark to build Facebook, he went to New York for an internship and missed out on an $80 billion opportunity. So And I didn't mean to get off topic, but I definitely thought that was important to share. Mike, back to Rich Dad Poor Dad. If you want to repeat the question.
Yeah, and so for anyone who doesn't know, Jared has the attention span of pretty much like a turtle. Like you try to tell him something, and literally, I could be telling him the most important thing about our business, and he'll be looking at his phone. I'm like, "Did you get that, Jared?" And he's like, "What'd you say? What?" Like, it's so frustrating. I can't believe that it just happened right now. It's like deja vu just every single day.
Yeah.
Anyway, the quote was, "Don't work for your money. Have your money work for you."
Right. And so, guys, listen, here's the thing. To have your money work for you, you need to first have money. So the question is, how are you going to go from dead broke to $20,000 in the bank, 30,000, 40,000? I think it was Charlie Munger, who's a very, very successful entrepreneur, who says all you need to do is get that first 100,000, and then if you have the knowledge, you can easily turn that into millions. And it's very true. You know, when I got my first 100,000, like that was the first time I actually felt for a second financially secure. I finally felt like I don't even need to make money for the moment, because even if I couldn't, I would be fine for, you know, a while. And ultimately, once I had that first 100,000, was when I started buying real estate right away, you know, dumping as much of it into diversified stock portfolios as well, and even new e-commerce businesses. So for you, obviously, I'm not saying you need to save 100,000, but you are going to need to save, I'd say, you know, 2,000, 3,000, maybe 10, maybe 15, 20. So that, in that point, yes, start with a job, because ultimately you will need to get money. But the question is once you get the money, what are you going to do with that? So as he says in the book, rich people make their money work for them, poor and middle class work for their money. So that doesn't mean that rich people never worked for their money. Like rich people, they still had to put the work in, whether it was to start their own business or at a job. But the difference is that as soon as rich people got that first initial 100,000, they turned it into 200, 300, 400. You know, the question is, if I were to hand you $100,000 right now, would you immediately think about going to the mall and buying everything you can and getting a car and getting a house? Or would you immediately think about all the investments you can make with that? You know, that's really the question right there, and your answer will dictate your future.
Yeah, exactly. And when your money works for you, and as opposed to working for your money, there's no time constraint. You're making money at all times, even if you're not working. This is a common theme that we're always going to be talking about. So get used to it. And so how do you get your money to work for you? You build assets. And so I guess that's a great. When I say assets, I guess that's actually the next point I want to talk about that Robert talks about in the book is assets versus liabilities. So how do you get your money to work for you is you build assets. And so the way that this is very simple terms, how he describes it in the book is assets is something that puts money into your pocket. Liabilities is something that takes money out of your pocket. Jared, I mean, you could probably list off 1,000 different types of assets. But if you want to just kind of talk a little bit more about that.
Yeah. So, I mean, listen, guys, one of the biggest misconceptions, and I know he uncovers this in the book, is that buying a house and living in it is an asset. That couldn't be further from the truth, because think about it. Even though you're putting the money down, and yes, the house most likely will go up in value, throughout that whole time that you own it, all it did was take money out of your pocket. So how can you consider it an asset? On the flip side, buying a home and having others live in it is an asset because it is profiting. I bought a house in Cleveland, and ultimately I pay $450 a month, and it brings in $1,500 a month. That is an asset. And guess what? That $900 a month profit, or $1,000 a month profit, think about how many things I can buy with that. And that's what he really wants to show in the book, is make money, use the money to buy assets like real estate properties, or start a business, or buying stocks with dividends, and then use the profit from the assets to buy a car. Like, think about it. A car lease typically is going to be, $200 or $300 a month if you get like a Nissan or a Honda. If you got an Audi or a Mercedes, you're looking at like $800 a month after insurance. If you really want to have that really nice car, then almost all you have to do is buy a real estate or buy a rental property, because the profit will be enough to pay for the car, and then you still have your income, whether it's from your job or your other business. It's the same thing. If you're making money, that's what he wants to teach you. It's not about what you make, but what you keep. And then when you keep it, what you do with it. How do you invest it? Do you buy assets? Do you build assets? Or are you just buying things that are going down in price?
Yeah, exactly. And Jared kind of used that as an example of where, if you do need a car, how you can pay for it. But if you're seriously trying to build like a lot of wealth for yourself and your family and future generations to come, is like Jared just outlined, is use your money, buy a rental property, use the profit. Now you can use that profit from the rental property to either, pay for a car lease that you need, or save it and then reinvest into another asset. And now you have two assets that are making money. And it's a continual cycle of, you know, building assets for yourself that, as we said in the first point, which everything's going to pretty much tie back to that, is having your money work for you. That's such a huge thing. And for so many people, let's say everyone's assets and liabilities, this is the assets and liabilities just evened out. Most people have this many assets and this many liabilities, when in reality it needs to be the opposite. And so when I say liabilities, like I said before, things that take money out of your pocket, no matter how much, it will add up. So let's say your house mortgage. Obviously it'll depend on the person, the stage of life, but just to name some: house mortgage, your car note, your Netflix subscription, um,
Phone bill.
your phone bill, your gym membership, things like
If
that.
you have
Yes,
kids.
yeah, you have a kid. Some things are obviously required liabilities, but there are things that you don't need. And so when it comes to building your wealth, as he explains in the book, that the goal should be to minimize your liabilities to need as little as possible. When you have not as many things taking money out of your pocket, you have more money. And when you have more money, you can now invest in things to put money into your pocket. It sounds like a simple concept, but like when it's dumbed down like this, but obviously it's a lot more of a difficult concept, when you put it in real terms.
Yeah, and I mean the thing is, it really is that simple. The difficult part is having the discipline to save money that you can actually
Yep.
invest with. Like the concepts to wealth are pretty simple. The difficult part is just acting on it, being disciplined. Like think about it like this. Working out is pretty simple. Everyone, whether they know how to work out or actually do work out or not, knows that if they go to the gym, lift some weights, hit the treadmill, they'll probably see some results. Building wealth is in the same way, just as simple as working out. Like you know what to do, but can you do it? It's like how many people know that they just have to go to the gym and then just don't go. With wealth it's the same thing. It's like you should be saving that money, but instead you're buying something you don't need. That you should be reading that book, but instead you're watching Netflix. That you should be building that business, but instead you're playing video games. It's the same thing as working out, because it's like you know what to do. The question is, are you going to do it?
Exactly. And I'm so glad you brought up discipline, because at the end of the day, everything that every part of building wealth comes down to discipline. And we've talked about it before, whether you're talking about your daily habits, your spending habits, what you consume. It really all comes down to discipline, because the useless things that rot your mind, they, like I've said before, they give you a short-term high. And so, like I said, be disciplined with your spending. Know where every dollar that you have, know where it's going. If you have to make an Excel sheet and write out your assets and liabilities and how you can minimize them, then do that. These are such important small things that you can do to really start getting on the path to wealth.
Yeah.
And so I know, like I said, obviously we just talked about assets, liabilities, and we did touch upon real estate. And so Robert's favorite asset to invest in is real estate. And like I said, Jared, obviously we have More Than Money, we have a particular way that we like to buy real estate. But Jared, why is real estate such a great asset?
So real estate is a great asset for numerous reasons. And the best thing to compare real estate to would be a long-term diversified stock portfolio, because in a lot of ways they do similar things. Now, people that like to argue that the stock market is a better place for investing, the only reason why they would say it is because typically those long-term portfolios go up 10% a year, and typically a real estate property only goes up 3% per year. But what the people that are pro stock market aren't including is the cash flow of the real estate investment. So for instance, my house that I purchased, that I own now, it may only technically go up 3% per year, and the house that I bought most likely will go up more, because the area is becoming gentrified, and gentrified just pretty much means reconstructed. Sorry, but the reason why they would say stocks are better is because they'll say 10% versus 3, but they're not including the fact that a house can profit $1,000 a month. So not only is it going up 3%, but it's also bringing in $20,000 profit a month, or $15,000 depending on the property. It could be even more. So typically, when you outweigh the cons, so think about it like this: $20,000 in a stock long-term portfolio going up 10%. That means it will make $2,000 in the year. But if I took that same 20,000 and bought a rental property that profits $900 a month, it's going to profit 11 grand, 12 grand, and go up 3%. So you can do the math right there, that even though the long-term diversified stock portfolio does really well, the real estate investment still outperforms it by a long shot. It's not even close. Now, we're also not including the fact that with every monthly payment, you own more of the house, and then it can eventually refinance, get that cash back, and buy a second house, or just get the cash back to have, or build a bit, do whatever you want with the cash. You don't have to buy another house, but typically that's what most people do, because it becomes obviously very addicting to want to keep buying houses. It's like playing real life Monopoly. And ultimately, when you combine all these factors, there's really no better investment than real estate. But here's the thing: the catch with real estate is that you do need some money to buy. I mean, you can't just buy a property without income, because the bank needs to see that the bank, if they're not going to give you a mortgage unless you can show 2 years of income. So unless you have 2 years of income, then you would have to be able to buy the house in cash, in full. So that's the hurdle with real estate, is that you need to show the bank 2 years of income just to get pre-approved for a mortgage, and you need to be able to afford the down payment. Now, if you live in New York like me and Mike do, then being able to afford a down payment is like impossible. I mean, because for a rental property, you have to put 20% down. If it's a place that you're going to live, then you can get 3 or 4% to put down, and that's why people can even afford to buy houses to live in, is because you don't have to put 20% down. But if you're making an investment, then you do have to put 20% down. And in Long Island, you're not finding a house in Mike's area. I don't think you're finding a house below $700,000 realistically. So 20% of that is $140,000. To save that up would take most people years. Now, if you go to a place like Cleveland, you can find pretty much the same house in Long Island that's $700,000 for $80,000, and instead of having to put down $140,000, you only have to put down $20,000. And here's the craziest part: is that it doesn't even profit that much less than a house that's 10 times as expensive.
Yeah, exactly. And so, obviously the rent may be higher in, say a Long Island, but there are just so many other factors that go into it. Obviously, like Jared was able to buy a house for almost $20,000 down, a 2-family home. It's a beautiful home. Like as Jared said, it's in an upcoming neighborhood. And obviously, if you guys want to learn more about this method of real estate, Jared's never seen this house, and he probably never will see this house. So if you're interested in this, yeah, if you're interested in this type of real estate, definitely check it out. We have another informational video over at havemorethanmoney.com. But yeah, and so as we've talked about before, building a business isn't for everyone. And this is something that we're going to keep hammering home. It's not for everyone, but building your wealth should be for everyone. And real estate is realistically the number one way to do that if you have a job. So it kind of all ties together everything that we've talked about, honestly. Having your money work for you. How do you do that? Assets. What is an asset? A home. Not a home, like Jared said, not a home that you live in. Because if you live in the home, money is being taken out of your pocket, hence is a liability. And these are all things from Rich Dad, Poor Dad that he says himself. If you live in your home, it's a liability, it's not an asset. It's a very common misconception. And obviously what we didn't talk about is, Jared did, like I said, he paid $20,000. So it's not like his first 6 months of rent is going to be profit for him. He still has to pay off the house. But when the house is paid off, or, when he refinances, there's going to be a point in time where he's just collecting checks that are going straight into his bank account.
Yeah.
And so, real estate is obviously a long-term game. But like most things are, if everyone could build their wealth in 2 weeks, everyone would. So,
yeah, and I should be profitable on that house within about 2 to 3 years, at the most. And then, like you said, it'll just be cash, checks, and at the same time, I'll be owning more equity each and every day. And one thing about Rich Dad Poor Dad that we didn't mention yet is how entrepreneurs pay taxes opposed to employees. So guys, listen to this. If you're living in a state where there's income tax like New York, right? The income tax on New York is 30%. If you're an employee, and you make $100,000, then that means you are going to pay $30,000 in taxes. If you are an entrepreneur and you make $100,000 profit, what will happen is you will ultimately pay off all of your expenses first and then pay taxes on what's left. It is such a big difference because think about it like this. I make $100,000, you make $100,000, you make it from your job, I make it from my business. You're automatically left with 70 right off the bat. You pay 30K in taxes. Then you use whatever's left to live your life. So it's like 30K is just washed away and now you're left with 70 to live off. Here's what I will do. I will make my money. I will live my life. So let's say I spent 70K, right? And I'm left with 30. I'm only going to end up paying $8,000 in taxes when you're paying $30,000 in taxes and we both made the same amount. To sum it all up, poor and middle class get paid, pay taxes, and spend what's left. Rich get paid, spend, and then pay taxes on what's left.
Yeah, exactly. And, obviously that example may have been a little exaggerated with spending $70,000, but yeah. I think Jared was able to obviously, get his point across. But what he means is, everyday expenses that, majority of expenses that you can think of that you spend money on, let's say your phone bill, your apartment rent, your car, getting food. I played golf last week and I plan on writing that off. Obviously, you have to speak to an accountant on what you can exactly write off. But I mean, like Jared pretty much has explained it perfectly. You then pay your taxes on what's left over.
Yeah.
And it's really crazy how rich people pay less in taxes than poor and middle class people. And it's honestly even crazier that, most average middle class, lower class people then complain, oh, like fuck the rich, like all this, like they're like they steal, they rob, like yada yada yada. When in reality, this is all knowledge that's out there. I mean, Robert Kiyosaki explains this in the book, plain and simple. The knowledge is out there for everyone. It's just a matter if you use the knowledge. I actually have a friend of mine who I spoke with just a couple of days ago, and he works he works for a private company that pretty much lends money to private businesses. And so, it's a pretty normal job. He makes commissions and half a base salary, I think. And he was telling me that he actually has an option from his company to work as an independent contractor. And so essentially he's now in the works of starting his own LLC and stuff. He's essentially going to start getting paid without getting taxes taken out. And so his company's going to pay him a check as an independent contractor. And now he can do exactly what me and Jared do. He can live his life, accumulate all of his expenses, and then after the end of it, pay taxes on whatever is left over, which I think is just absolutely brilliant. And obviously this may not be available for everyone, but if it is, you need to be doing that.
Yeah, and what Mike didn't mention is the way to do it, and that is very simple. Open up an LLC and then tell your company that's how you want to get paid, is as an independent contractor, because then they legally can't take the taxes out before they pay you. They have to pay you first, and then you get to take advantage of all the tax benefits. And ultimately, if you do that, then you can literally make, let's just say you and your coworker both get paid the same amount. You can literally pay a third of what they pay in taxes, 100% legal, just, using the system to your own advantage. A lot of people, they like to become a victim of society, but there's a lot of loopholes in society, and, it's your biggest disadvantage can ultimately be your biggest advantage in life. And that's, it's David and Goliath. It's the story that, your disadvantage can be your advantage. That's what we mentioned in, I don't remember if it was this video or an earlier video, that, coming from less, in my opinion, was a bigger benefit to me, because a lot of my friends that came from more just don't have the drive that I have.
Yeah, no, exactly. And it's really spot on. At the end of the day, rich people are rich because there is a certain way to do it. It's almost down to a science. There are certain things that you can do to become wealthy. And this, tax, I don't even want to call it a loophole, because it's legal. It's not like this is illegal stuff, but this is just one way to do it to build your wealth. So now, let's say you save. Let's say my friend who I talked about saves, I don't know, $4,000 from write offs and doing it in this manner. He gets $4,000 extra, and now let's have the beginning of this whole video. He can now have use that money to have that money work for him. So now he can invest it in something else, and it's really just a domino effect and a continuous cycle of, like I said, having your money work for you, taking that money and putting it back into it. If you only think short term and you don't have long term on your mind, then this is just not ever going to be an option for you.
Yeah.
If I give someone a $4,000 check, chances are they're going to blow it on something useless. And so, it really, like I said before, it just comes down to rewiring your brain.
Yeah. And I mean, guys, that, those are honestly the most important concepts of the book. I mean, at this point, you don't even need to read the book because that pretty much is the summary. And, I just want to show this real quick. So, guys, it's June 2nd as we're recording this, and one of my stores just broke $100,000 in sales. It's just 2 days into the month, and, a bunch of sales. We just did $2,000 while recording this video. And I mean, if that isn't making your money work for you, then I don't know what is. I mean, I'm living my passion right now. This was always the dream. Me and Mike, we always dreamed of being able to pass down this information and get paid while doing it. And that's the beautiful part. That's why we can put out videos for free on YouTube, because we don't need to make money off the video. We're doing the video because we simply want to do it. But I mean, in the meantime, we're literally making sales. And as you see, this store did 100K this month, and it's only June 2nd. I mean, I can't say I've ever done that in my life, but here we are broadcasting it.
Doing 2K in revenue while recording a video, that is literally your money working for you. Like, yeah. If that's not the textbook definition, then I just don't know what is. Yeah, I mean, I think Jared may have been exaggerating a little bit. If you guys do want to check out Rich Dad Poor Dad, definitely maybe we'll drop a link in the bio. We covered pretty much all the main aspects of it, but there are a lot of small tips and details that, we probably left out. So, check out the book. Like I said before, if you're interested in getting started in real estate or opening up your own LLC so you can start reaping these tax benefits, definitely head over to havemorethanmoney.com. We'll drop the link in the bio. If you like the video, swing us a like, subscribe for more entrepreneur mindset, e-commerce videos. We're not going to stop pumping them out. And if you guys want to see some of the future videos, be sure to drop a comment.
Yeah.